Hello, ladies and gentlemen. It's our investment show, Modern Financing. And I would like to introduce, first of all, my name is Sasha Starr, and my guest for today is Milan Sombarok, the author of Monday Morning Millionaire.
Delighted to be here. Thank you for inviting me.
Thank you. Milan, please explain to us how it works in details, especially considering your six numbers that ways of implementing your wonderful investment system.
Well, first of all, I want to tell you that I'm delighted to be talking about money because while we know that money isn't everything, it's way ahead of whatever is in second place. And the other thing is that the only thing that money cannot buy is poverty. So there is a huge conflict of interest between Wall Street and Main Street. Us, we are Main Street. So Professor Elbroy Dimson has shown and repeatedly shown, and he's with the London Business School, that investing in global equities is the number one investment possible unless we're cherry picking. Cherry picking means instead of comparing to the S&P 500, which represents the American market, the American economy, we decide we're going to compare that to San Francisco real estate. For every San Francisco, there's a Detroit. We can compare it to Toronto real estate. It's done better than the S&P 500. For every Toronto, there's a Sarnia. So generally speaking, without cherry picking, the American economy has been the best place to invest for 100 years and more. Now, the conflict of interest between Wall Street and us consists of a number of issues, one of which is, for example, we tell our members, and our members follow this, that money which we are going to need in the next 2-3 years does not belong in the market. How much does Wall Street make on that? The other thing that we tell our members is they should have an asset allocation between the market as represented by an exchange traded fund which tracks the S&P 500, such as SPY. So we should have a balance between that and cash or near cash. And that asset allocation should be somewhere between 50-50, 60-40, 55-45. It doesn't really matter. That's not important. The important thing is to have that in place. How much does Wall Street make on any uninvested money that we have? So they want us to be fully invested, which is a mistake. They want all our money fully invested, including the money which you're going to need tomorrow for groceries to pay the rent. So the conflict of interest is there, but we can protect ourselves against that because, as Professor Dimson has shown, equities are the best place to be compared to stamps and gold and silver and violins and various other investment programs that are out there. So 5 reasons we should be investing in the stock market. One is the best place to be, unless we are cherry picking. Second one is constant quotes. That's so valuable. Every second, you know what your security is worth. You don't have to hire an appraiser. Number 3 is liquidity. Whether you're buying or selling $1,000 or $1 million, you can follow how long it takes for that transaction to occur. Seconds. It takes seconds. Number 4 is the transaction costs. Today are so low, we can totally ignore them. And number 5 is record keeping. All of us are lousy record keepers, but our banks are required by the government to keep records that are good enough for the taxman. So those are the reasons why we should be investing in the market. And so we tell our members, and our members follow this. Our members we have about 400 members who are primarily professional people like dentists and physicians and pharmacists and veterinarians, optometrists, and a number of others who are business people. And about half of our members are Americans and the other half are Canadians. Uh, and so we tell them there are 6 principles which they need to follow. Number one is save. Without saving, nothing else works. The other 5 don't work. And we should save, just to spend a second or two talking about saving, for a number of reasons. One is the earlier we start, so that we have time working for us, that we have compound interest working for us, the better off we are. So people who start saving as soon as they start working, say in their 20s, should save about 10% of their annual income in order to be able to retire at age 65 and maintain their living standard. If they start saving in their 30s or 40s, they need to save much more. People who start saving in their 40s need to save nearly a half of their income in order to maintain that lifestyle. So that's one of the issues concerning savings. And the other one is, it's one of the few things over which we have total control. We cannot control anything in our investments, the market movement, the taxation, the rules and regulations. We can't control anything except our savings rate and frequency and our division of assets. Those are the only 2 things that we can control. So that's the reason why we need to save. So the 6 points are: number 1, save; number 2, do it yourself. Do it yourself. We can teach a high school student how to equal the market by purchasing an exchange traded fund which tracks the S&P 500. Trying to beat that seldom works. Yes, there is the odd, the David Swensen and Peter Lynch and Warren Buffett. Warren Buffett hasn't been able to equal the market for the last 5 years, although he's done double that for the last 40 years. And so buying the American market is the 3rd point. So number 1, save; number 2, do it yourself; number 3, buy the American market as a whole, no stock picking. Number 4 is buy and hold. No attempt to time the market, buy and hold. Number 5 is adjust that buy and hold with your asset allocation, let's say it's 50-50, so that when the market goes up and you have more in the market than in money or near money, then you take some profits and rebalance it to your 50-50 or whatever your asset allocation is. When the market goes down and you have excess cash, you buy bargains. What happens typically when the market drops? People are running for the doors. The same people who try to buy bargains in the grocery store, and when they're buying a car and a pair of shoes or anything else, are running for the doors when the bargains abound. So number 5 is adjust this asset allocation of whatever it is, 50-50, to buy when the market drops and to take profits when the market rises. That results in our being just as happy to see markets dropping as we are to see markets rising, because we are buying bargains and taking profits. When you read the Wall Street Journal or any financial paper, they're constantly wringing their hands and crying when the market is dropping, instead of saying, whoa, we're in bargain territory, which, by the way, we are now. And the 6th point is, if we cannot explain an investment to a 10-year-old, we shouldn't be into it. So to recapitulate briefly, save, do it yourself, buy the American market as a whole, no trading, rebalance when the asset allocation is thrown off, and avoid complexity. So those are the way to invest our core portfolio. It's boring, and Samuelson, Nobel Prize-winning economist, said, yes, investing should be like watching paint dry, watching grass grow. It should be boring, not very exciting, as Nick has pointed out. So we tell our members that they could have up to 10%, 5 to 10% of their investable assets in what we call a fund portfolio, where they can do all sorts of things that nobody should be doing, such as active trading and day trading and getting involved with puts and calls, buying puts and calls instead of selling them, and penny trading. The list of what we can do that we shouldn't do, that Wall Street want us doing, is very long. And we can do that in a fund portfolio And nobody needs a fund portfolio really to do well. We can do very well by following these 6 principles that we talk about. Save, do it yourself, buy the American market as a whole, no trading, rebalance when the balance is thrown off by market movements, avoid complexity. We can do very well doing that. And studies show that professionals cannot outperform that approach over a market cycle. Yes, they can do it over a week, they can do it over a month, they can do it over a year. A market cycle, which is peak to trough to peak, very few professionals can manage to do better than these 6 points that we talk about. So that's the story. The only thing, there's nothing to say really. I've said it all. And so the only thing that I can talk about, and I'll be happy to do so, is to talk about what we can do in our fund portfolio, hoping to make a buck, which doesn't always work, but it's the equivalent of going to Las Vegas without going home. So is that what you wanted me to tell you, Sasha? The story, I told my story.
Listen, Milan, thank you so much. I would like to elaborate on just one thing. You mentioned that number two, do it yourself. You mean to actually trade or invest into S&P 500? Let's
Yes.
say a SPY. You can do it with any discount broker and just execute your order. And to keep the cash equivalent in money market funds, which will pay some nominal interest, maybe 3%, 2%, 4% if interest rate will go high.
Really? Yes.
And then essentially what you're saying is that the market goes higher, so you sell some of it and you enhance your cash or equivalent of cash portfolio. And then when market drops, you are moving money from your cash portfolio to S&P 500. Actually, it reminds me this is a system of so-called cost averages. When you're buying certain stock, you're buying more stock when the prices are lower and less stocks when it's higher.
Let me interrupt you for a minute here, Sasha. Yes, dollar cost averaging is one of the very few ways that you can reliably beat the market if the source of income is from another place other than your investments. That is, if you're working, and you have a source of income from your job, then dollar cost averaging works extremely well because where the same amount of money in the same security during the same time intervals, when the market rises, you're buying less the expensive market. When the market drops, the same amount of money buys more bargains. But if you have a lump sum of money, such as many of our members say, they sell their practice, and usually they get more money for it than they've ever had to handle in their lives, then dollar cost averaging does not work very well. They can't take that lump sum of money and dribble it in effectively.
There is another concept of the strategy of buy and hold. It works very well on a long-term strategy such as S&P 500 with equivalent of cash portfolio, whether it's split 50-50 or 60-40, it doesn't really matter there. I think it depends on your age group, where you are. It depends probably on your income situation. Now,
your risk tolerance too. It depends on your risk tolerance also.
That too, and also there's something. Let's see, if you're talking about retirees where they're not pulling large salaries, they have pension, for example, and in this case, that system still works because you still have sizable portfolio of cash and equivalent of S&P 500, and you just shuffle money between accounts. Depends on a situation in the market. The dollar cost average, though, doesn't work very well with this individual stocks because individual stocks now and stocks, all stocks are not equal. If you're talking about very stable, so blue chip stocks, it's one story. If you're talking about stock like lately Snap, for example, when it went down in a matter of last few months, it went down 75%. So if you would use dollar cost average on that stock, you would lose a lot of money. Really.
Excellent point, Sasha. But notice our point number 3 is don't buy individual stocks, buy the American market.
Absolutely.
Talk about blue chip stocks. uh, of the thousand or more automobile companies that existed at the end of the 19th century, there were only three left in 2008. Two of them went bankrupt. And those were blue chip stocks. So, yeah, dollar cost averaging would have wiped out that investor doing that.
Absolutely, absolutely. If you remember, the good example was, do you remember it's Canadian company Nortel?
Oh, yes.
Remember, their stock
Yeah.
went up to $140 a share from a couple of dollars or so on. And I remember a friend of mine, he had a lot of shares of Nortel at the time. And when Nortel went down to $80 from 140, he told me once I met him, he told me that he's going to the bank to take a line of credit to buy more Nortel stock at $80. And I asked him, what makes you think that the stock cannot be $70? Why do you think that $80 is the bottom for the stock? He said, it was for $140 just a couple of months ago. I said, that's right, but it's today 80. So it can move up to 140 again, but it could go back to 70. What about $60? What prevents Nortel going down to $60? He said, no, 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 you don't understand. It's such a wonderful company, and it has products and
It
this.
makes things, yes, yeah, that's right.
You know the story. It went down and in bankruptcy eventually. It went down.
The most interesting thing to me about Nortel is, yeah, I had a friend who did the same thing. When it dropped to a half, about 60 or 70, he decided to jump in, and it went down to below $1. And all the executives of the company walked out rich, and nobody went to jail.
Yeah, that's right. Listen, there are a lot of people who are, for some one reason or another, doing obnoxious things in life, and they're not going to jail. I have one very good example, which everybody knows, but I'm not going to call a name because I don't want to sort of denigrate the our program, really. So I'll keep that name away. Now, speaking about fund portfolio. So what you're saying is that it's like going to casino without leaving home, and I could agree with you on that. Even if you are using prudent strategy, and but you want to have really fun, and you want to really instead of just putting in a casino on roulette, red or black, with which is 100% gamble. You'd rather do some intelligent decisions, but they are riskier than just buy and hold. It's not S&P 500, which you will hold for years. They're mostly options, I would say.
Yeah.
There are some more extravagant stocks, which some of them are doing actually quite well from time to time. Let's see if I'm talking about Nvidia, or I'm talking about, say, Qualcomm, for example. They're premier companies, and they were all went down with all this market downturn lately. But they're still awesome companies, and maybe from time to time you can use that to, for example, what I like to do. I'd like to give people examples of what I'm doing personally. Not please follow what I'm doing. That's not something what I recommend. Sometimes I'm doing what I would never recommend to anybody
In your fund portfolio, yeah.
in my fund portfolio, but I'm doing that, sometimes successfully, sometimes not. So, for example, I have a few hundred shares of Nvidia. So now I was afraid that it will go considerably down. Although in the long term it will move up, I have no doubts about that. But in the short term, it could continue to move lower simply because of market conditions, interest rates, inflation. There's too many factors. I don't want to even list them because for that you can listen to CNBC or some other financial shows. What I was doing, I sold covered calls on Nvidia when stock was about 170. And because I'm a very greedy person, much greedier than most of the people. I'm pretty sure about that. So I sold the closest calls, which are expiring this Friday, July 29th. And I sold them while stock was 170. I sold, believe it or not, 167 calls in the money.
Money, huh?
So the premium is enormous.
Much larger in the money, of course. Yeah.
Yeah, it's enormous premium. So I got so much cash for this call. So I decided, listen, let me keep calls. And the worst case scenario that the stock will be called away at
Sure.
167.5, but my cost was below 150. So I'm still making money on the stock, and I'm making money on the covered calls. What could be wrong with that? Absolutely nothing. The only thing is you are walking away from opportunities that Nvidia can go to 200, 250, 300, and just name the number.
Yes, yes.
But once, let's see if by most likely on Friday I will be exercised. Stock will be called away.
Yeah.
But stock market opens on Monday at 9:30 in the morning. So I could go back to the market and buy all those shares.
You're going to buy it at a higher price, though, right?
Or lower, depends how the market opens.
So if it's called away from you, then you have to buy it at a higher price, right?
Not necessarily. If the market will go lower on Monday morning,
okay, yeah.
I may buy it even at a better price. Or you're right, it could open higher. So in this case, I will overpay. But the money what I made on options covers more than enough whatever extra premium I'll have to pay to buy back the stock. If I want to buy back the stock, maybe I'll wait a day or two, maybe it will go lower. But again, this is a fun portfolio. So, so I can, the fact remains that in this transaction, I'm not losing. So by Monday, Tuesday, or whatever it might be, I could buy stock again and sell covered calls at the same time with the closest expiration date and collect a little bit more cash.
So, Sasha, did you say that you're greedier than most?
Yeah, I think so.
Okay. Now, we have a member who has a university degree in economics as well as an MBA. And so he sells covered calls on selected securities, which are stocks that he would be happy to own forever. So Intuitive Surgical is one example.
Premier company.
Yeah.
Wonderful company.
One Oak is another one. Triton is another one. So he selected them. And then he sells covered calls out of the money, far enough out of the money so that his return is about 1% a month. 1% a month is 12% annually, which is much better than the market has done. Over the last 100 years, the market has averaged about 10%, not inflation adjusted, with huge fluctuations, of course, but averaged 10%. So what he does with these securities that I just mentioned, Intuitive Surgical, One Oak, Triton, is he sells just far enough out of the money, not in the money, not just out of the money, but far enough out of the money to make 1% a month. That lowers the risk of having his security called away from him and being assigned, lowers the risk of assignment enormously. It can still happen.
I could agree with the strategy if he's talking about dividends paying stocks, especially.
Yes, it is. Right.
If it's not high yield, if it's a stock like Nvidia, which pays a negligible dividend, I'm not scared of assignment. I'm very happy to be assigned, and so I will increase my cash position substantially, and I will have more than enough money to buy on Monday, Tuesday, whatever it might be, stock back if I want. If I want to do it, really,
that's an attitude that works and it's effective. But most people don't like to be assigned. You'd have to agree with that.
On dividends paying stocks, yes, I hate to be assigned because once it happened to me when I had CIBC, and which was paying dividend on Friday, and Friday was also expiration day of options. I sold calls, and I was assigned on Thursday, a day before dividends, a day before so okay, I made money on stock, I made money on options, but I lost my dividend. It's
Well,
not a big deal.
we say to our members that if they invest following the 6 habits that I just described, luck hardly matters. Good luck.
No, but
Luck.
we're talking about a fund portfolio. I'm not
I'm
talking about.
talking about a fund portfolio. Luck is pretty important. So you had some bad luck there.
Okay. No, no, but I'm not complaining because overall it was very profitable because I collected money on
Yeah.
the dividend. The sorry, dividend I didn't collect. I collected on a premium on the covered call. I made money on stock as well, so I just lost a tiny bit of on dividends. So Monday comes, I'm buying back CABC actually at better price and selling covered call again. But this
Well,
is fun portfolio. In
well,
my
why
core
is that?
portfolio, I'm not selling options at all. I
Of course.
just keep high
Oh,
yield, paying
yeah.
dividends, and that's it.
But related to what you just said, Sasha, there will always, never say always and never say never. But
Oh yeah,
I'm saying there will always be better investments than the one we have.
absolutely,
So, so
totally agree with you.
so you did very well, but you would have done better had it not been called away from you. So we needn't concern ourselves about better investments than the one that we have because they're always there. There's always a better way to invest.
You see, it's very difficult to predict
You can't.
exact price of a stock a few days away or even a few weeks away. It's impossible to predict exact price. So
We,
therefore, the idea of selling out of the money covered calls or at the money or in the money, this is exactly what you have to do. You have to, if not predict, but at least have a feel where you expect stock to be at the time of expiration. So in my situation at this market, I thought that I should play safe. And of course, by selling, let's say, Nvidia at 170, I could sell 180, 190 calls. The premium would be considerably less than what I did, what I've done. But my strategy was to save myself from a big drop on the price of the stock from 170 to 160 or even 150 if not lower. So in that case, the giant premiums that I've collected definitely covered my cost quite considerably. So I was not afraid if market will drop, or Nvidia in particular, from 170 to 160 or 155 or whatever it might be, because I've collected enough premium to cover the potential loss. And even that potential loss would be only a paper loss because my cost was 150. So in either case, but I was a little bit more careful simply because I was afraid of market downturn.
Well,
It's
you were saying, Sasha, that it's difficult to make predictions, and
difficult, yes.
we tell our members to read predictions for amusement only, because and especially in January. In January, all kinds of people are predicting what's going to happen the rest of the year, and when you take a look at the correctness of those predictions, they have almost an impeccable record of being wrong most of the time. So
I
read
totally agree with you.
Yeah, yeah. So look at predictions for amusement only, and you really almost have to predict in order
No,
to.
Dylan, but again, let's not mix the core portfolio and fund portfolio. In
Yeah,
core
yeah,
portfolio,
exactly.
you
Yeah,
don't care about predictions one way or another. Now, in
exactly.
fund portfolio, it's a big part of, let's see, a choosing, let's see, even covered call we are talking about, a choose to sell which month, which expiration day, which strike price. And this is all based on, first of all, I believe that you should sell as closest covered calls as the time of expiration as possible. So let's see if selling, of course, I could get way much more premium if I wouldn't sell July 29th call. If I would sell September call or December call, I would get tons of money. But we are talking about a sitting in a way, sort of like there is a fluctuations of stocks. You have to wait so many, 5 months until.
Do you know that recently, I think within the last year or three, SPY has expiry date twice a week. You buy
Yes,
it on
correct.
Monday, you can sell it
If
on
not
Wednesday.
three, I think it's 3 times a week
Oh,
now.
a lot, and nobody's ever shown that that's useful. But in a fund portfolio, it can be fun for sure. Yeah, you
I
can.
wouldn't sell options on S&P because, first of all, to
Yeah,
sell covered call on S&P, you have to own S&P. Now, if you own S&P in your fund portfolio, That's no longer fund portfolio.
You're right.
If
You're
you're holding S&P, you'd rather hold it in your core portfolio, and you can augment your return by selling occasionally covered calls on S&P. Now, what's the danger that it will be called away, so you'll buy it next Monday again?
Yeah,
It
a
will be
security that's as safe, S&P 500 is safe. You're buying the American economy,
yes,
the strongest
correct.
economy in the last couple of hundred years. You're talking about safety, and the safer security is, the lower the fluctuation, the less return you get on selling your covered calls. You need something with a lot of volatility in order to get a bigger return. So now the S&P 500 has had huge volatility twice in the last decade. But when it was there, investors made an enormous amount of money on a very safe security. And yeah, the volatility, generally speaking, most of the time isn't significant enough to give a sufficiently good return in a fund portfolio.
Yeah.
But
So there are two words. It's a fund and portfolio. If you have fund but no portfolio, it doesn't work. You have portfolio and no fund,
yeah,
not my cup of tea as well.
yeah.
So, listen, we had a very productive discussion today. Thank you so much for your input. And I would like to discuss, but not today, of course, we have no time, but the next, we will discuss the selling, not buying, but selling uh, puts,
Protective puts.
protective puts, cash covered puts,
Yeah.
and we'll see how we can use this for fund portfolio. Just very short example to this. If I like Nvidia, and let's see if it will call. Let's see it will be called away my Nvidia shares on Friday. Instead of going on Monday and buying them back, I may sell. In fact, puts on Nvidia, and hopefully I will get that stock by selling puts, and I will collect premium from the puts, and I will get the stock back. And one more thing, that puts will provide me enough cash to buy calls on Nvidia, simply because if there will be unexpectedly very strong move up.
On any security, the dividends that it might be paying is, you can almost ignore it compared to the premium that you can get for the week.
Absolutely, especially stock as Nvidia, which is paying minuscule dividends. So we will discuss it definitely next week. Milan, thank you so much for participating on program,
Thank you
and
for inviting me. Thank you for
goodbye.
good.
And to all our listeners, my name is Sasha Starr, Milan Samborg at our program Financial Show on IBN TV, Pod TV. Thank you so much, everybody. See you next week. Bye bye.